Howdy, Jacob here. Today we're looking at PulteGroup, company 98 of our high ROIC screener. We see that return on invested capital has been pretty much very consistently increasing over the last 9 years, with revenue jumping from 5.8 billion in 2014 to 16.1 billion in 2023. Gross margins slightly up, operating margin almost double. Very impressive. In the household durables industry, 24.5 billion market cap and enterprise value. Been around for quite a bit, 1950, headquartered in Atlanta, Georgia. Looks like they acquire and develop land primarily in residential purposes and construct housing on such land. Okay. I always get confused when I see the industry of household durables, but it's like a home building business. So um, just keep that. Balance sheet 1.8, about 2.3 billion in liquid assets on 2.4 billion long-term debt. So no concern on that balance sheet. Pretty much have enough cash to wipe away that long-term debt, and they produce cash flow like crazy. Capital expenditures are less than double what they were 10 years ago, but cash from operations are, almost seven times what they were 9 years ago. So they are producing a hefty amount of cash. The use of cash is a little bit on acquisition side, maybe 5 to 10% acquisition. The dividend is paying out maybe 15, 20%, and then share change is a very large amount, maybe 50, 55%, with debt being the remains. So interesting use of cash, probably pretty similar. I mean, again, I haven't done an in-depth analysis, but just based on what I'm seeing here, that looks to be a pretty reasonable use of cash. We'll see whether they're buying back shares at a reasonable price or not, since they have been consistently buying back a plethora of shares over the last 9 years. Let's look at that shares outstanding number. 370 million outstanding down to 220. So you own a lot more of the business over here than over here, and darn it if they're not producing way more revenue and earnings. So great, would have been a great investment the last 10 years. Let's see what it's going to be over the next few years, next 7 years for this analysis. So for revenue growth assumptions, it's a home building business. That's probably going to be pretty close to inflation. Maybe do 3%. Let's do 15 based on the fact that this is just a random bet. I have no idea. If anyone says they know, they're clueless. But I think when interest rates drop, I don't know if that's going to be this year, next year, 3 years from now, but this is a 7 year analysis. And I think that I'd be surprised if over the next 7 years, the interest rate for houses didn't hit back down to like 5%, which would make monthly payments for many people who need mortgages much more reasonable. And I think that that would spur up demand quite a bit. So I do think that 3% is more than reasonable, just because in the near term, with interest rates being as high as they are, obviously we're seeing a shortage of supply, so prices of the homes are still high. But I think the production of homes is going to wait until demand kind of spurs again. And so 3%, 15 on the P, price free cash flow, based on the fact that they reinvest this back into the business, they're going to get massive returns. And although their reinvestment isn't great, I do think that they deserve a P, price free cash flow, in line with the market for sure. And then for margins, we have 13 on the earnings, free cash flow 10. I don't like that. Earnings are higher, but like I said, still producing hefty amount of cash flow, so I'm not super worried about it. Okay, let's do 12, 11, and then share change. Their current price of 24 billion would cost 240 million. Let's say a billion is 4%. Let's do 3%, because they produced free cash flow in excess of 2 billion this year, but before that was averaging a little bit over a billion. So let's do 3%. That'll give them 40% or so of their free cash flow to use towards acquisitions, reinvestment, debt pay down, paying this dividend. And the dividend itself, pretty reasonable priced right now. They've been increasing it over here. Like I said, it's like 15% of their free cash flow. So let's increase it a little bit more than revenue. Maybe by the end of 7 years, it'll be more like 20, 25%. And that gets us to a price that needs to fall still over in half before you're getting the return I'm looking for here. Um, Again, another great company. No surprise through the screener. Another great company, just one that I want to buy at the right price. So hopefully you enjoy the video. Have a great rest of your day. Thank you.